Hello, everyone. In this session, we're going to talk about the consolidation. And that's very common in the exam. You will get at least one question from here. Even it's not the financial statement, but it can be profit and loss account. We don't know which one is going to be in the exam. But almost 30 marks will be in the exam from the consolidation. So either from the statement of financial position or from the profit and loss account. So both sides you have to practice, make sure you understand everything, especially the workings. So let's have a look what we have here. When you look at the financial statement, we have to prepare the balance sheet. So the standard format we have here, that is asset, and we have a equity and liability. So the financial statement has to be matched. So our total asset has to be equal to the total equity and liability. Top of that, we'll see a few workings on the right. So we have a goodwill, we have a PPE, and the written earnings. So these three workings, the major workings that will be in the exam. So you need to make sure like this not the only workings you have to do. Rest of the workings you have to do by yourself on the white paper, but these three workings have to show actually on the exam. So it's very important you remember this three format of the working. So practice enough so you can remember all of that. Let's read this quickly. This question, we know what they're asking. They're asking to prepare the financial statement. They said like there is few information we have here. And they said if there's a negative, use the minus sign or bracket. So if there is something negative, you can use the minus sign or you can use the bracket. Both will be accepted. There is no direction or instruction for the any other thing. So that's it. So simple as it is. Let's have a look the information we have for the statement of financial position. So that's our balance sheet. And this is the further information. We need both of them. Remember that the financial statement for the consolidation, they always give us for two companies. So one will be the parent and one will be the subsidiary. Now, when I said parent, parent means the main company, the company going to buy share from other company, and the other company called the subsidiary. Now, for the AAT, you're just looking at only one subsidiary, but in future, maybe if you study ACC or CIMA, you're going to see like more than 3 or 4 subsidiary at the same time. And sometimes you're going to look at something called associate. But in this AAT exam, you're not going to see any associate or any subsidiary more than one. It will be quite straightforward. They will tell you like either you have purchased some share or they will say number of share you buy. Let me tell you what is the difference. So if the question tell you percentage is quite straightforward. For example, this question, they said you buy 80% share. That means from the total share of subsidiary, here the Texas is our parent and the Houston Limited is our subsidiary. Quite simple. So we can see the Houston Limited written earnings and the share capital. This is £300 and share capital is 240. Remember that always look at the subsidiary share capital. So we have a share capital 240. So in this 240, and we buy, for example, 80% for this question. Now, 80% when you buy, this is a very straightforward, we buy 80%. The question says, share capital and the voting rights. The reason they said both, because if this is only share capital, this is possible. You might not have the voting right. It's very important. You should have the voting right. If you don't have the voting right, that means you cannot control the company. Now, to be a group of company, to prepare a consolidation financial statement, you have to have a control over the subsidiary. Very important. Without the control, even if you have a lot of share you own from another company, you will not be able to prepare the consolidation because you don't have the controlling power. So it's for that reason you have to have a voting right, and the question clearly says we have a voting right 80%. Okay, fair enough. So this one is 80%. Other way they can say, like, for example, out of 400 240, they said like you own 100 share. So from 240, if we own 100 share, that means 100 divide 240, and whatever is the percentage, that will be the percentage. So either they can give us the percentage straight away, or maybe we have to do some workings to find it out how many percentage I own for that company. So we know it's simple, so it's not difficult anyway. So let's have a look what we have here. So the financial statement is quite straightforward. We have a PPE, we have inventory, receivable, cash and cash equivalent, share capital, retained earnings, trade payable, taxation. Few things we just need to add. For example, the PPE, we just need to add these two. Investment in Haston, so P Limited invest in H. So for that reason, you can see 420. 420 is the money that P Limited paid to H Limited to have 80% share. So for that reason, it is investment on the P Limited financial statement because they made investment to buy H Limited. On the other hand, everything we just need to add together, need to make a plus, other than only have to see some workings for the share capital. So share capital was 240. The reason we cannot add both because this is the group of company represented by the parent company, and the parent company is the Texas PLC, and for that reason you can see here it says Texas PLC consolidation financial statements, not Texas and Haston. For that reason, you have to only take the share capital for Texas and the share retained earning for Texas. We cannot take both. We're not going to add it. Only how much we own from here we'll take, and how much you own from the retained earnings we take. Other than everything is kind of we just need to add. Simple as this. Okay, let's read our additional information what we have here. On the further information section, is 80% owned. Good. How much we paid? 420. Then how much was the share capital that time? 240. You can see the 240 here. And how much was the retained earnings at the date of acquisition? 20. Now you can see the day I buy 1st of January subsidiary, that day their retained earning was 20. And at the end of the year, the financial statement is year ending. Remember that. So at the end of the year, the retained earnings is 60. That means from January to December in this year, I make 40 pounds, isn't it? So 20 was the day I buy, and at the end of the year 60. So during this period, I make 40. So in this 40, I'm going to take 80% of profit from there. So how much I make during the period I'm with you, I will take 80% of that. All right. Also, there is a fair value adjustment, 100. That means the PPE, property, plant, and equipment, will be increased by 100 because this is the increasing of the fair value. So how much is the carrying value we have now? So 241 plus 1520, you need to be added by 100. The fair value always increase. Also, the fair value will have impact on our goodwill calculation. Then we have some information for the impairment. Remember that if there is impairment of the goodwill, that means the goodwill will be minus by 25. So how much is the goodwill we're going to calculate? We're going to reduce 25 from the goodwill because there is impairment. Also, if there is any impairment of the goodwill, that will be reduced from the retained earnings as well. Remember that. So the total retained earnings for the Texas PLC will be reduced by the same amount, or the goodwill will be impaired. Then we have a next one is as included in the trade receivable of Texas PLC, and in the trade payable of this is called intercompany. So basically we're going to minus 6,000 from the subsidiary and 6,000 from the parent. So when each company, so when they sell to each other, for example, one parent sell to subsidiary and subsidiary sell to parent. So if this is the case, it is not our sell because the sell between us, it is not the sell. For that reason, we have to take it out from both receivables and the payable. So 6,000, we're going to take it out from the payable, and 6,000, we're going to take it out from the receivables, from the total. And they said the NCI has to be value under the proportion of shares. So that's simple as this. So let's have a look at now question now. Let's try to do it together. So the way I do goodwill, I do a little bit different with the workings, but of course, like you can do the way you like, not a problem at all. So let's have a look how I do that. So to calculate the goodwill, I need my net asset. So net asset calculation. On the net asset calculation, I separate it in two sections. One is at acquisition date, the date I buy this company, and one is called post-acquisition date. Post-acquisition debt. The post-acquisition debt after the year end. So acquisition debt means the date I buy this company, and the post-acquisition debt after the year end, what we have here. So let's have a look. And this net asset, remember, only for the subsidiary, not for the parent. So let's have a look. First, we take the share capital, 240. Share capital, 240 and 240. And then we have return earnings. Return earnings we have here. At the date of acquisition, we have 20. So 20. And at the post-acquisition date, at the year end is 60. Then we have a fair value adjustment, 100. And is there anything else? I think that's it. So all you have to do, you have to add it now, how much we have. So we said 240 plus 20 plus 100. That's 360. So 360 is the total. And I have by 80% of the subsidiaries. So you multiply by 80% times 80%. 360 times 80%. And that gives me 288. And I paid 420 for that. So the consideration is 420. 420. And if you minus that, minus 420. So the goodwill I have here, 132. That's the goodwill. But also the question said goodwill is impaired by 25. So you need to minus 25 to find it out how much is the goodwill. So that gives me 107. So that's my goodwill. So you can see here, the share capital, they have 240, and the retained earnings, they have 20 the day of acquisition. And also the fair value is same for both. So the total net asset of the subsidiary was 360 on the date of acquisition, and I buy only 80%. So 80% represent 288, but I paid 420. So how much I paid extra? This is my goodwill. So for 288 pound asset, I paid 420. So I paid 132 pound extra because of the goodwill. But the question said goodwill will be impaired by 25. So minus 25. So actual goodwill is 107. On the other hand, here we have a 240 plus 60. So 240 plus 60 plus 100. So you have a 400 here. And we need to multiply by 20%. So 400 times 20. And that gives me 80. And this is my NCI, non-controlling interest. We need both of these to make the calculation. So let's have a look. All right. So once our working is done, our life would be very easy. So let's start with that. The first we do the goodwill. Let's do the workings for the goodwill first. The way it shows, we just follow the template. So consideration is 420. And then non-controlling interest, this is 72. So non-controlling interest on acquisition. $72. Then the net asset accrued. This is 360. And the goodwill impaired, 25 minus. Minus 360. So 107, we have the goodwill. Now the non-controlling interest acquisition, you can see we have a 80 is the NCI we have calculated. for the subsidiary. This one we need later on. And non-controlling interest of the acquisition, that means if 80% is the acquisition for the parent, so 20% is for our subsidiary. This is the one they mean 72. That's the one they are trying to show like how much it is. So if you have a look, 360, 80% is 288. That means 20% for the subsidiary is 72. So don't be confused. But this working is very helpful to do the rest of the question very quickly. All right, the PPE, let's quickly do this one, property, plant, equipment. So we have to add it together, the subsidiary and parent. So we do 241 plus 1520, 241 plus 1520, that will give us 1751. 61 actually. 1761. That's my PPE. Consolidated. Remember, always take the consolidated because it's together, it's both company. Then you have a fair value adjustment for 100. So adjustment for fair value 100. That's my total PPE. The last one, you have a retained earnings. The retained earnings, we only take the parents. Remember that. Retained earnings, we only take the parents. So we take the retained earnings for parent. So we said retained earnings excess PLC 172. And the difference between how much I get from here, so this is from the subsidiary, is 32. Let me show you how we get 32. So the day I buy the subsidiary, their returning was 20. And after 1 year, when we are together, at the end of the year, 60. So during the year, actually, we make 40. Because 20 was already at the beginning. So on 40, I can take only 80% because I own 80%. So 40 times 80%, that gives you 32. And finally, as I said, any impairment will have impact on the retained earnings. So impairment of goodwill will have impact on the retained earnings at minus 25. So that will give you 179 total retained earnings for the parent. That's it. So all of our work is done. Now just we need to complete our financial statement. So let's do that. First we do our goodwill, 107. Property, plant, equipment that we have done, 1861. That's it. And then we have inventory. Just need to add everything. So inventory 64 plus 238. So 302. And trade receivables, we have to do a little bit of adjustment. If you remember, we have a 6,000 intercompany. So we do 30 plus 120, that is 150. So 150 we need to write here, trade receivables. I'll show you how you do that for the payable. So we have the payable 103. Let's have a look. So 103 plus 26 minus 6. And that will give us 123. So let's do the payable 1, 2, 3. Remember that when you do the payable, you have to be careful. 103 plus 26 minus this 6,000. This is included in the trade receivables of Texas PLC and in the trade payable of Houston PLC at 31st December 2011 is the intercompany balance of 6,000. So if there is any intercompany balance, you have to take it out always. All right. So then we have a cash and cash equivalent. So we have a 39 plus 18. So 39 plus 18, that's 57. So 57. So total asset we have is 150. Okay, so 2477. Then share capital, share retained earnings, everything. Remember the equity section, share capital and retained earnings only for the parent. So we have 172 plus we have calculated 32 minus 25. So the share capital we have 1800 for the parent only, 1800, and retained earnings we have 179. 179 the retained earnings, and NCI we have calculated, remember 80. If you remember the first workings we done for the NCI, that was 80. And the taxation we need to add 34 plus 842. And what else we have here? So 1800, 79, 80, 2059. We have some non-current liability here. Yeah, we have a 19 plus 234. So 253. That gives me exactly 2477. Now this one thing you have to be careful. When you look at this one, the intercompany balances, so you have to be careful. If it is profit and loss account, you have to look at how much profit they make for each other, and you have to take it out from the inventory. And also, like, it will have impact on the retained earnings. So included in the trade receivables in Texas PLC and in the trade payable of Hassan P Limited, 31st December 2011, intercompany balance of 6,000. Now, normally, what we do, obviously, like it has to be minus from both. So trade receivables and the trade payable, we add it together, and we minus 6 minus 6. Remember that, because it's intercompany sale. So T sell to H. Now, obviously, when they are together, now they are become one company. So if they become one company, so if they sell to each other, it's not the sell for them. For that reason, we have to take it out, intercompany balance. So we added the trade receivables together, minus 6, added the trade payable, minus 6. So from both companies, the balance will be take off. And after that, our financial statement will be balanced. This question is very common in the exam, so make sure you revise. And obviously, like it can be the profit and loss in the exam as well. It can be financial statement, can be both. All right, let's have a look at the next one. This is our consolidation. The next one, we have the ratio analysis, quite simple question. So let's open our profit and loss account. Okay, open our financial statement. Ratio analysis is very easy. If you remember the formula, it's a very easy thing. So let's have a look what we have here. So the first one, you have the inventory holding period. As soon as you see the days, that means you have to multiply by 365. Now there is a 3 days question can have in the exam. One is for the inventory, one is for the trade receivables, one for the payable. Story is same. For the inventory is a closing inventory divided by cost of sales. So inventory divided cost of sales times 365. It is trade receivables, then receivables divide sales times 365. And if there is a payable, then payable divide cost of sales times 365. So you need to remember all of this. We don't know which one will be the exam. Current ratio is a current asset divide current liability. So current asset divide current liability. Gearing is debt divided by debt plus equity. So debt divide equity. Sometimes in the question, if you don't see the debt plus equity, then you look for the net asset. Net asset. Remember that net asset and the total debt plus equity is same thing, or you can look for the capital employed, is same thing. So don't be confused, like what is information, they can make the question other way, so you need to understand that. Asset turnover is the sales divide the total asset minus current liability. So sales means revenue minus total asset minus current liability, yeah. Or you can say net asset. So revenue divide net asset. Net asset represent the total asset minus current liability. The return on capital employed, ROCE, this is a profit from the operation, divide equity plus non-current liability. Or you can say profit after tax, profit from operation, not profit after tax. Profit from operation, divide the capital employed. Capital employed means total equity plus non-current liability, or you can say capital employed means net asset, or you can say capital employed means total asset minus current liability, same thing. All right, let's have a look. Now they're asking to make some calculation. Inventory holding days. Let's have a look. How much is the inventory? 4620. So 4620 is the inventory. Divide by cost of sales. The cost of sales we have here 47,875 times by 365. So let's have a look. So 4620 divide 47,875 times by 365. That's 35.2 days. So I said 35.2 days. One decimal place, so we take one decimal. Then you have a current issue. Current issue is quite simple. Current asset divided current liability. So that's my current asset. So that's my total current asset. And the current liability. So where is the current liability? That's current liability, total current liability. So current asset we have is 16,259. And current liability we have 9238. And it has to be always ratio by 1. Remember that. So let's do that. So we have a 16,259 divide 9238. So this is 1.7 1.76. So you can say 1.8. So 1.8 is to 1. So 1.8 is to 1. Next one is the gearing, debt divided debt plus equity. So let's have a look. Debt means the long-term debt. Remember that. Debt is we have a bank loan. So 32,755. And debt plus equity. So 32,755. And the equity we have 47,624. Percentage times by 100. So let's do this one. 32,755 plus 47,624. That gives me 80,379. 8379. So 8379. Is times 100. And that gives a 40.8%. So 40.8%. Asset turnover, revenue, divide total asset minus current liability. So let's do that. Revenue means the sales. So 86,004,082 revenue. On the bottom, total asset. The total asset we have here 89,617 minus the current liability. We have 9,238. And this one we have to show as a times. So it's 1.1 times. 1.1 times. And ROC, return on capital employed. Return on capital employed, ROC, so we have profit from the operation. So the profit from the operation, we have 14,657 and total equity plus non-current liability. So total equity, we have 47,624 and non-current liability, the bank loan, 32,755. And that gives me 18.2%. That's it. All right, let's move to the next one. The last question we have. Question number 8. This question give us some scenario and we have to explain something. So let's have a look. So it says like LB, a potential investor, has asked you for your assistance in analyzing A Limited to help her determine whether or not she should buy share in the company. Lisa has recently received a large cash sum from a pension plan and is keen to invest in A Limited after reading a report in newspaper that industry sector in which A Limited operates is performing well. We have calculated the following ratio in respect of A Limited most recent financial statement and have obtained an industry average for each of the comparative purpose. So this is the performance for A Limited and also the performance in the industry. Okay, ROCE is not very good because return on capital employed is better on the industry, not in A Limited. Working capital cycle, A Limited is better because money is getting quicker, so they convert the money into cash in 18 days. Inventory, receivables, and payable. On the other hand, in the industry is 29 days. The quick ratio is better in industry because 1.5.1. That means like their asset is 1.5 times compared to the liability one, but their asset is only 0.9 compared to liability one. That means even if there any situation come, if the if the supplier want their money back, if the supplier said pay for all the bills and all the liability you have to pay, then A Limited will not be able to pay because they have only 0.9 against 1. So they will not be able to meet all of their current liability. Interest cover, industry average is very good. 3.5 times they can pay the interest from their profit, but A Limited can only pay 2.2 times. So comparing all of this, it doesn't look like A Limited doing really good, except the working capital, everything is bad. So this is bad. Return on capital employed is bad. Quick ratio is bad, and interest cover is also bad. Only working capital is stated to be better. Okay, let's have a look at what they're asking. They're asking assets analysis. Okay, return on capital employed. Let's have a look. Give some comment. So we'll say ROC is less than the industry. ROCE is less than the industry average. That means she will receive less return than the other company in the same industry, isn't it? Because if she invests somewhere else, then she will get more money than investing here. Working capital is better. We can say working capital is good. Because of the shorter period, and maybe this is the reason, because maybe they are not allowing too much credit to the customer, and that's why their sales is not very good. Because if they don't allow customer long period, for example, if they said every single customer have to pay 10 days or 15 days, on the other hand, their competitor in the market, they give 30 days or 60 days to the customer. So obviously the people will go to that company. So maybe this is the reason their working capital is better, but actually there is not many people buy from them. Quick ratio is not good because very more risky. then industry will not be able to pay the current liability. So when you're writing this sort of question, always give the difference. What is the difference between the industry and the company you are analyzing? So you can say like ROC is a less 4% compared to the industry. You can say working capital is better by 28, 21 days or 14 days. So you need to see this, always say the difference. Remember that. Then interest cover is not also good. Less profit available to make the interest payment. So less profit to pay more times interest. Of course, if I have less profit because I'm giving less credit time to the customer, so that will have impact on the interest cover. The formula for the interest cover is profit divided the interest. So I can pay less interest. So I would say like this is because of the lower profit margin, and industry average is better than a limited. Thing like this is okay. If you understand the concept, you can write a lot because this is all the thing. You can say the reasons. When you writing question, all you have to do, you have to say like, what 3 questions you have to answer yourself. When you write the writing question, you always ask yourself 3 questions and you have to answer of these 3 questions. For example, if I see the ROC here, I say like, what's happening here? So I will say like industry average is better than like, for example, 3% because 14 and 11. So 3% is better. Number 1, so what's happening, I'm writing here. Number 2, we're going to write why happening. So we need to say like the profit margin is low. That's why it's happening, because profit is low. That's why it's happening. And what is the recommendation? So don't buy. Do not buy from this company. Simple as this. So every single thing we have to ask 3 questions. What's happening? Why happening? And what is the recommendation? That's it. All right, so I hope it makes sense. You understand everything. And if you revise, well, obviously it's not going to be a difficult thing at all. Hopefully, like you will be able to answer all this question. And the recommendation, as I said, like do not buy this because only the working capital is okay. Other than everything is not very good compared to industry. So we advise not to buy share from that company. All right. Thank you very much, everyone, for watching. Hopefully, it will help to understand a few questions. If you have any question, feel free to email me. You have my email on the description. Thank you very much.